I'm Monty from Valor. If you have a big exit coming up or are selling a highly appreciated asset anytime soon, you should watch this video to learn how you can avoid paying taxes when selling the asset and keep more money in your pocket. As an example, a Californian realizing a $2 million capital gain could earn an additional $7 million. Let me repeat that, $7 million, life-changing money over the course of their lifetime by using a tax planning structure called a Charitable Remainder Trust. In this video, we're going to be talking about Charitable Remainder Trusts, which are also known as CRTs, and three key areas. When are they commonly used? So when should you think about using it? What are the key benefits? And what are they and how do they work? Let me get started. Most people use Charitable Remainder Trusts for two reasons. One, and this is the most common, is tax planning benefits. Or in simpler terms, how can you reduce and avoid taxes when selling highly appreciated assets or receiving an IRA from someone else? The second key reason is if you not only want to provide an income for yourself or your family, but also have charitable intentions. Now, some people do it for one reason or both reasons. It really depends on your goals, but both are really powerful and can be leveraged with this structure. But most people are really curious about the tax planning benefits, so let's dive into that. There are a few practical tax benefits of Charitable Remainder Trusts. First and foremost, they're tax-exempt structures. This means that when assets are sold inside of a Charitable Remainder Trust, you don't have to pay taxes on the sale. And instead, you can use those tax savings to reinvest in whatever assets you want to create more wealth for you and your family's use in the future. Secondly, you receive an upfront tax deduction when you contribute assets to the Charitable Remainder Trust. Typically, it's about 10% of the value you put into the trust, which is the estimated value of what the trust will donate to charity at the end of its term. Lastly, you can protect the assets inside the trust from creditors. And for most people, the most important benefit is the tax-exempt nature of the trust, which can be really powerfully paired with selling highly appreciated assets. In the words of Charles Schwab, now Charles Schwab is the guy who founded the bank. It was named after him, so it's not just a bank. Charitable Remainder Trusts are particularly suited for appreciated property because any capital gains tax will be deferred until the time it is distributed out to the income beneficiary, you, and therefore the donor can contribute highly appreciated concentrated positions to the CRT and diversify his position in a tax-effective manner. Now, I'm going to let that sit, and I know that's a lot to digest, so let's break that down with an example to really see the benefits. Let's say you're the New York-based owner of a small business. You've invested your life building this business, and you now have an offer to sell it for $10 million. The cost basis of your business is $0. You expect to pay about 35% in long-term capital gains, or $3.5 million. It's a ton of money that's leaving your pocket and going to the government. That would still leave you with $6.5 million, which isn't bad. But this is your life's work. You really want to maximize it when you're selling this business. So let's compare that to if instead you used a Charitable Remainder Trust when selling your business. After gifting shares in the business to the Charitable Remainder Trust, you'd receive about $1 million charitable deduction, which lets you as a New York resident probably write off about $500,000 in taxes. Pretty good start, but that's not even the best benefit. Most importantly, when the Charitable Remainder Trust sells the business, it'll keep the entire $10 million and be able to reinvest it. And so this means instead of having $6.5 million to invest and build your wealth, you have $10 million or nearly 50% more to start with. Now, let me repeat that last part. That's just to start with, as over time that difference will grow. And let's explain how that would work. Let's say after you sell your business, whatever you invest it in will grow about 10% a year. If you don't use a Charitable Remainder Trust, your $6.5 million will grow by $650,000. Pretty good. On the other hand, if you use a Charitable Remainder Trust, that $10 million in that trust will grow an additional $1 million or $350,000 in additional growth in that first year. And every year that will continue to grow and grow. Over the course of your lifetime, you could expect to create an additional $30 million from using the Charitable Remainder Trust, or 171%. You're wondering, why is this so powerful and how is it creating so much wealth? It comes from really one simple concept. Assets in tax-exempt structures grow faster than assets in taxable accounts. Or in other words, if you pay taxes on assets, they will grow slower than assets you don't pay taxes on. This is the same reason and same concept behind why the government encourages people to build their wealth in individual retirement accounts, or IRAs, a structure you may be more familiar with. All right, that wraps it up. Hope you enjoyed the video. If you have any questions or recommendations for the next video, let us know in the comments below. And please like, share, and subscribe so that you can learn more about all types of trusts and other wealth building tools. Now, if you want a free consultation, simply visit our website at valor.io It's linked below, and you can connect with us. And a quick word about Valor. We've built a platform to give everyone access to the tax planning tools of the ultra-rich, like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up the structure, and administer these structures at a fraction of the cost of competitors.